Okay, so this week was actually not bad. We had the FOMC decision on Wednesday, and they decided not to raise the federal fund rate. But there's expectation now. There's something like a 70% chance that they may go up a quarter point in July. We'll see, as we move forward, whether that's going to happen or not. Um, But if we go back and we kind of look at the week that was, um, get these data up for you. Let's take a look at the daily. Let's look at the primary markets here. We'd been forming this head and shoulders here, and this week we kind of went in. We had a little bit down today, but if you see even the weekly, it forms this head and shoulders pretty well. Now that head and shoulders doesn't guarantee that it's going to go up, uh, but there's, I believe the percentages are something like 60% that they typically go up, and so that means a 40% chance it's going to go down. So you have to take it with what it is, and I'm optimistic, and I think not necessarily cautiously optimistic anymore. We had such a strong week. We're in such a strong bull trend right now. Uh, that should make people nervous to a certain degree. But right now, because the momentum is still there, um, you know, my expectation is we'll see things go up. I think David Hunter's forecast short term is to hit 460 before we start to see a pullback. I mean, a significant pullback, I guess one might say. But the good news from my standpoint is, I've been waiting to kind of clear this green bar here. That's, this is again weekly data on the SPY, S&P 500 index. They have last October marked the bottom, really, at least to this point, of the bear market, and we've gotten out of this vicious downtrend that we were in for most of last year and part of this year. Um, Going through hitting, coming back, but now we've cleared this uptrend from there, and I'd like to think that we get on the good side of this. Doesn't mean necessarily that we can't go back below it, but I think you know we may have a pullback here to 418 or so at some point in the future, but there's enough momentum right now that may carry us through to David Hunter's forecast of 460. And once you hit there, even with a pullback, I mean, you've still got lots of momentum. You have room to have uh, a higher low here, or maybe a consolidation period that won't affect the momentum. It's gone up quite a bit. I think that then you'll have the momentum to 480, and then Hunter's forecast is that after 480 the melt up will begin and things will happen fairly quickly. His expectation all of this will happen this year before we run into the bust. Um, I'm keeping an eye on IWM. Which is the Russell 2000 with a lot of smaller companies. It's got a long ways to catch up. The Dow Jones, led there for a while and then just kind of been sitting here making this head and shoulders pattern. But this has lagged behind for so long that my expectation that is still that this would uh, break out and we start making our way forward in the indices. So that's in essence look at markets. So just to kind of finish it out, we have the 10-year Treasury note, the yield, maybe up just slightly for the week. The dollar uh, was up today, but for the week was down big time. And I'd expected it maybe to hit up in this area up in here that we've touched a number of times, but it fell short. So now we have a lower high on the weekly, and so we may, we'll see if that carries back under 102, which was our previous low, or excuse me, 100, which was our previous low, 100 and some change, and do a lower low, and kind of get that pattern going on the weekly. It might take a few weeks, but 2 or 3 weeks maybe for that to play out. Crude for the week up just a little bit. We're kind of in this cone pattern waiting to break either up or down. My expectation will be that it breaks down, and we'll keep track of that. The VIX continues to go lower for the week. I think that might be slightly lower than last week. Let's see, 1350 last week, 1348. So yeah, so a new recent low at least. And again, that takes us back all the way back in February of 20, when it was right before the pandemic hit, and then things spiked. So, that it can stay down here for a while, and history has proven that, and get even lower than we are now. We look at some of these back in 2017, 904. You probably go back a little further, $9 or so. I mean, that's still $4.50 below where we're at. As far as volatility goes. And then the other good sign from my perspective is, we continue to see, and again, a weekly chart, we're seeing more participation, slowly grinding up. But in order for us to hit new highs, we need to have more participation in just the FANG stocks. So we'll see what transpires as we move forward. We've hung out down here. We got a double bottom here, potentially a double bottom here, and making our way back up. Okay, we'll go back to some of those things a little bit later. Let's take a look at. Let's go to the calendar. We'll go to this week. Okay, we're there. All right. So this past week, kind of setting things up on Tuesday, which is really where significant data started to come out. We had expectation month over month that we'd get a 0.2% increase in the inflation rate. We came out 0.1. We expected 5.3 on core inflation. Came out 5.3. Slightly lower on of what was expected of 4.1 to 4, but a significant drop, from the previous month as far as the inflation rate goes. The 30-year mortgage, 6.77%, slightly down. I think we're going to see that figure continue to melt down. I think even next week to see what happens, transpires between now and next Wednesday. PPI, for the Producer Price Index, down 0.3%, which was more than expected, which is, again, good news. The Fed held, and then Chairman Powell had the press conference, and every time he says something, the market goes up. It's kind of funny to watch, but the FOMC standing still, and as I mentioned, at the moment, the expectation is that they will increase a quarter of a point next week. If we go beyond that, who knows? And then retail sales came out a little bit stronger than expected. Expected decline of 0.1%. Initial jobless claims came a little bit hotter. And then our manufacturing index is down on the Philly, New York State Manufacturing, Empire State Manufacturing Index up, where it's been really beaten up. So you hope that it goes up every once in a while. Nothing goes down on a straight line, but it was it's still weak, but at least it's something positive. Then Michigan consumer sentiment came out today a little bit stronger. All these are a little bit surprising, but we are starting to get some relief in inflation, especially in food. It's mostly rent that seems to be holding, or leases are holding things back. The commercial real estate market is in a huge mess. Looking at next week, remember on Monday we don't have the markets won't be open, excuse me. And then you got a series of housing data, which I think will be significant. Building permits, housing starts. You got Fed Chairman Powell testifying to the House next Wednesday at 10 o'clock. That could be something significant. Again, at the moment, I would expect mortgage rates to be down just a little bit. And then Thursday, we have more testimony. I'm guessing that's for the Senate for Chairman Powell. Initial jobless claims, see what those come out. And then the PMI, the S&P PMI, still give us an idea if manufacturing is still contracting. My expectation is it will. I'm surprised that services is not at this point, but it's hanging in there. People still going out to eat, I guess. So my final comments are really, I want to go back to some of the things that are happening that as an investor to kind of keep your eye on. We have Target out there. It just was in the crosshairs of both sides of the argument over pride paraphernalia and all that type of thing, and they paid a price for it. And similar to Bud with the whole trans thing, rocketed down here, and it's just kind of meandered along at a lower level. And I think the company that illustrates what not to do the most, and I think is going to really pay in the long term, and a stock that I generally am involved with, but I just don't understand their strategy here. But Disney has a target audience of families. That's who goes to Disney World. That's who goes to Disneyland. Now, maybe things are a little bit different in California, but I can tell you, in the Midwest, where a lot of people go, they want it to keep family friendly. Now, there may be different definitions of that, but my belief is that Disney is going to continue to pay a huge price. I just see downward pressure here. Now, Disney World, yeah, people are going to Disney World just like they have been. We were locked down for a while, and so they will continue to attend right now because people want to get out, and Disney World hasn't really changed that much yet. We're starting to see some strange things happen at Disneyland, but as far as Disney World seems to still be kind of the family-friendly place, even though they don't say ladies and gentlemen, boys and girls anymore, which is completely ridiculous stuff. But we're being indoctrinated by Disney, and I don't think that that's the appropriate way. People want their children to grow up like they did. They talking about whether they're transgender or gay type of thing. Worry about that when you're an adult. So I think Disney, after the, unless they change their tune, I think after if we have the melt up and we have the collapse that both Peter Schiff and David Hunter are talking about, and a few more people are starting to gather that chorus, it's when people don't have money, they're really raking in the money right now at Disney World. But first thing you're going to cut is what do you have kind of negative connotations about? And I just think Disney will wind up paying a price here. But it's gone through a great time period, maybe where they feel like they can get away with doing ridiculous things. But I'm staying away from the stock for now. Anything to do. I've been trying to tracking data on ESG, DEI, corporate and quality index. You got all these things that are going on that have nothing to do with making better products and services. And I do believe that the companies that get away from focusing on creating better products and services and get into all this other ancillary junk are really going to wind up paying a price here ultimately. And one, in some cases, because they're going against their target audience, and two, it's one of those things where you're focused over here on something that is not going to make your products and services better, and it's just going to. I think companies getting away from that, getting distracted by this. I'm starting to see things, from companies that I've worked with in the past where they're telling me that, well, we're going to be graded on, ESG and DEI and CEI, and you got BlackRock and Vanguard and State Street trying to force behaviors. If you listen to Larry Fink of BlackRock, and I these people. I don't know what they're thinking. It breaches their fiduciary responsibility, and I believe that ultimately BlackRock will probably, and some of these other companies will get sued for breaching their fiduciary responsibility to make better products and services, for profit. All this other stuff is just crap. So anyway, that's really my final message, and I'm watching some of these companies. There have been data that come out on where they're claiming ESG and DEI are making it better. I've heard Mark Cuban even say this. But the data that are being reported by people who have a vested interest in it. And most of the data that I've seen that's not from these people that are invested in it, it's like having BlackRock do their own, analysis to see if ESG and DEI is good because they promote it. But as far as independent firms going out and basically saying, these companies are underperforming, and now you're starting to see with Target and Nike and Disney and Bud Light and or InBev Corporation, since Anheuser-Busch was purchased by a European company. It's just it's beyond me why they would risk some of these things. The one that seems to be hanging in there at the moment is Nike, but all their stuff's overpriced anyway. But they get lots of endorsements, and that's how they are able to sell. But I think that goes away in a recession or a depression where people are saying, well, wait a minute, the shirt that I have on, just because Michael Jordan or Tiger Woods or somebody like that doesn't endorse it, is really the same material. I get the same benefit from it, but I'm paying 2 or 3 times the price because they advertise so much. I don't know. We'll see. This is what I'm seeing coming, and I see organizations kind of have fallen into this trap, and we're just now, I think, at the very beginning of seeing some backlash on some of these companies doing these things. But we'll find out. But if you're going to be a good investor, you got to keep track of this stuff and understand what's going on around you with these companies. That's what I wanted to cover this week. And remember, there's always a better way.